Why do people love to hate Aunt Cathie? Well, let's look at some possible reasons. So she's quite smart. She's wildly successful. I think the media outlets put her net worth somewhere in the range of $250 to $300 million. She speaks a lot to you-know-who. And Sir Elon of Musk has fallen out of favor with the media, possibly because he's starting to lean towards a particular political party. Well, Aunt Cathie does as well. And this last reason is probably the most interesting. She's lost a lot of investors' money. So if we're being honest here, the only one we should really care about is that last bullet point. Now, I think most people making that claim probably haven't done the math. That's what we're going to do today. And just remember that it's not over yet. And investors who jumped on her ship, they knew the risks going in, or at least they should have. So what we're going to learn today, we're going to look at the complexities of benchmarking. We're going to look at various ways of calculating return. And of course, what you came here for, how Cathie Wood's 5 biggest active ETFs have performed. And just remember, it's not over until the fat lady sings, as they say. And I put in fat lady in generative AI, and it gave me a picture of this beautiful young woman here. So let's take a look at this table of Cathie's ETFs. This is from a Barron's article back in 2021. Now, the first thing you'll notice here is just how much AUM Cathie had. So close to $49 billion at an expense ratio of 75 basis points. That means she would have been taking down $367 million in fees with just 30 employees. So it should be no surprise that she's managed to amass a decent amount of wealth. And Barron says here, ARK ETFs had phenomenal returns last year, but 2021 is presenting a tough start. Now, note that today, Cathie's ETFs, they collectively have about $8 billion in AUM or $60 million in fees, which isn't too shabby. So when we look at the track record of performance for ARK's flagship fund, now, this is what volatility looks like. So you can see the years going up from when the fund was launched in 2014. And the big year, of course, 2020, when everybody thought Cathie could walk on water, she returned 153% with her flagship ETF. Now, looking at the last 2 full years here, you need to be very careful, and here's why. So I'll give you an example. Let's say D-Gen John used his stimmy check to buy $1,000 worth of the flagship ARK ETF, ARKK, at the beginning of 2022. And he apes into Aunt Cathie's ETF because all the FinTwats are saying it's the next Tesla. He promptly loses 67% in 2022 and starts 2023 with $330. He then gains 68% in 2023. So it's somewhat intuitive and a mistake to make to think that if you lose 67% on an asset and you gain 67%, that you should be at par, but that's hardly the case. So he would exit 2023 with $554, a loss of 45%. He would then proceed to lose another 19% in 2024 year to date, having $449 left and having lost 55% of his money. And of course, he hates Aunt Cathie with a passion. So with volatile assets, it all depends on when you got on the ride. And this article from Barron's that we're going to refer to a bunch today, I'm just going to read this paragraph because it's really good. So the title of the article says, ARK's Cathie Wood disrupted investment management. She's not done yet. And here it goes. Andrew Michael, a 65-year-old product marketing engineer, made a bold, many would say imprudent move last June. Indeed. The longtime, typically conservative investor sold 2/3 of his retirement savings, which had been invested in broad market index funds. So he was doing good up to that point, and put the money into 2 red-hot ARK exchange-traded funds. Within a few months, he made enough for a down payment on a second home in sunny Tampa, Florida. I looked her up and it all sounded really good, he tells Barron's. I started investing with ARK just 3 days later. Well, he's going to have possibly some problems making the payments on that second home because this was a very irresponsible decision to make at his age, regardless of the outcome. That's very important. So when people make stupid investment decisions, go all in on one stock, and then it happens to work out, they say, see, I'm the next Nostradamus. No, you're an idiot, because when you make gambles like that, the odds are against you, with only 5% of active professional investment managers being able to beat a benchmark in the long term. So that late stage in his life, that was a really irresponsible thing to do. So Cathie is known to be a maverick, and Andrew should have recognized this in his research. So from this article, indeed, Wood's high-octane style was putting off some institutions, and AllianceBernstein, where she worked, wanted guardrails on her funds. Her portfolios were often deemed too volatile. Well, we can see that. And Cathie says there's a void evolving in the marketplace having to do with innovation, so she disagreed with that. She wanted to take on lots of risk. She saw that investors in private companies were willing to assign higher valuations to companies than stock investors were. So we've looked at that, particularly in the context of SPACs, to see valuations pre-SPAC and post-SPAC to try to identify opportunities there. There's really a big disparity, so I don't know how predictable that is. SPACs certainly didn't do retail investors any favors. We covered over 100 of them, and Cathie thought there was a huge opportunity there, so she pounced on it. Now, how much time do we give her before the proverbial fat lady sings? Well, the ARK Innovation ETF, their flagship, was launched on October 31st, 2014. So I think a decade, we're coming up on a decade now, is enough time to start making some observations. Now, the spoiler alert here is that Cathie's moment hasn't quite arrived yet. Now, is she going to keep kicking the ball forward and saying, oh, it's 5 years from now? Hell yes, she is. First of all, nobody can predict the future as to when these fine wines will mature, so to speak. But how much time do we give her? Well, I think 2 decades should suffice. So, especially given her persistence that we're 5 years away. Well, fusion and quantum computing are always 5 years away. So you need to draw the line somewhere. So we're going to give her 2 decades. She's halfway there. So let's get back to performance. Here you can see, this is for ARKK. Cumulative performance since the fund came into existence, 133%. Is that good? Well, compared to what? And here we start to recognize the challenges of benchmarking. So we have numerous thematic ETFs we need to benchmark. Using SPY or QQQ doesn't tell us much, the S&P 500 and the NASDAQ. So let's start with their flagship product, ARKK. $6 billion in AUM. I put the AUM numbers along the bottom so you can see how those have changed. So she now has, $8 billion and $60 million in fees. Is not bad. Nearly 76% of total AUM for actively managed ETFs is in that flagship. So what benchmarks does ARK use? Here you can see in their fact sheet for the fund, they're using the S&P 500 and the MSCI World Index. So MSCI World is simply all developed markets in the world. Standard, which is large and mid. This doesn't say ACWI. That would mean it included small. So I worked for MSCI for a decade, and I'm quite familiar with their index products. So first of all, she's marginally beaten the S&P 500. She's taken on loads of risk to do that, so that's not very compelling. But are these the most appropriate benchmarks? What about the tech-heavy NASDAQ index? Would that lean more towards what she's trying to do? It would certainly make her not to look so good, as we'll see a little bit later. Now, getting very granular on this stuff is difficult because these themes can't be described by typical industry classifications. What about creating some custom indices? Well, Cathie went and worked with MSCI here. You can see her along the bottom. It says that her Big Five, AI, robotics, energy storage, DNA sequencing, and blockchain technology, are game-changing innovations that will transform the way the world works during the next 5 to 10 years. She worked with MSCI to launch some indices, and you don't have to look very far to find competence at MSCI, so we were really interested to see how Cathie's strategy would translate into indices produced by MSCI and vetted by their quite skilled research team. So look, here's one of the indices they produce, the Autonomous Technology and Industrial Innovation Index. And you can see the difference between July 2020 and May 2024 in terms of the top 10 constituents. I just put that there for your reference. But we did a piece on this. It's titled About MSCI's Global Innovation Indices. You can search our website for that. And here It points to the 4 indices they built. The one I just mentioned, genomic innovation, fintech innovation, next generation internet innovation. So these 4, you can see they have a lot of stocks, a lot more than Cathie has in her ETFs. And this statement by MSCI is interesting. It's in the methodology. It says, the component indices are subject to expert input and insight from ARK that is consultative in nature and utilized by MSCI at its core discretion. So let's map these out. Here you can see where they map almost exactly to ARK's ETFs. What was Cathie trying to do here? Probably trying to build some benchmarks that she could use, and we're going to use them. Now, when we look at the fact sheet for this particular index, the Autonomous Technology and Industrial Innovation Index, we have returns, and we can see, all right, the 10-year return. So if we take that annualized return and translate it to cumulative, a 15.43% annualized return comes out to 320% cumulative total return. So we can compare that to ARK's Autonomous Tech ETF. That had a 12% annualized return, or 193% since inception. So it's underperformed. Now, we do have 4 months to go before its 10-month birthday. And to be fair, we should wait until ARK has had a full 10 years. However, this gives us a glimpse into how things are progressing. So ARK's performance since inception, here's what you've all been waiting for. Starting with ARK, we simply benchmark this against the QQQ, which is the top 100 stocks of the NASDAQ, so it clearly doesn't beat that benchmark. And then we used NASDAQ, and I'll just say these. So our ARKK, 11.35% annualized returns. QQQ had 18%. And 1Q, that's a broad NASDAQ benchmark, had around 16% return. So ARK didn't beat either of those benchmarks. That brings us to ARQ, or ARKQ, 12% return versus the MSCI equivalent at 15%. The only one where Aunt Cathie is beating the benchmark would be ARKW, an 18.8% return versus a 17.5% return for the MSCI equivalent. Then we have ARKG, the genomics one, that's roughly matching MSCI. So, and then we looked at ARKF, her fintech ETF, that's well below the MSCI equivalent. So just some concluding thoughts here. 95% of active managers, as I said, can't beat a benchmark in the long run. Volatility moves both ways. People always forget that. So everyone thought Cathie walked on water when performance was good. Now she's the scum on their shoes. So the key questions here. Do you believe Cathie's big 5 are the way forward? And mostly, yes. And perhaps in the blockchain space, there's a bit of a stutter there, but mostly, yes. Is she the right person to stock pick these themes? Well, ask me in 10 years. But if someone with strong experience like Cathie has, and unlimited resources really based on all her fees and AUM, if she can't figure it out, then just who can? So this is precisely why we only allocate 15%, I think it's less now, to our own disruptive tech portfolio. So I'm going to go ahead and leave you with this piece we did on ARK's trade alerts. I think a lot of people cite these on Twitter all the time without understanding what they really mean. Give that a watch. Please make sure to subscribe to our channel. Thanks so much for taking the time to watch this today.